In this lesson, we're going to discuss consolidation patterns. What are they? Why are they important? And how do we use them? Quite simply, a consolidation pattern is the market's way of indicating to us that it's building up some energy to make a move. Sometimes the market will just make a move that we can't see coming. However, there are other times where the market is telling us what the next likely move is going to be. Let's go over to some charts and see if we can't understand why they're important and how we use them by just visually seeing how they work and how we can identify where a consolidation pattern is and what it's telling us about the next likely move in the market. One thing we know about the market is nothing moves in a straight line. The market ebbs, the market flows. Our trading opportunities are going to come when we can identify the market making a certain pattern that's indicating to us what the highest probability move is next. So here's a good example, and I want to start at the top of the chart. The market broke down from the top. It started going lower, but found support and began moving sideways. As traders, we may not have been able to catch the move down from the top down to here. However, once the market began moving sideways, our interest gets piqued. Why? As the market began moving sideways, that's the market's way of indicating to us that it's building energy for another move. The probabilities are that the next move is going to be lower. Why? Because a consolidation pattern is like a way station in between two moves. So here the market moved down, it consolidated, and after the consolidation pattern, it will generally resume the original move. In this case, down again. Now let's take some things that we've learned in previous lessons and see if we can put them together with this consolidation pattern from the high point all the way to the low point. I think you'll find this rather fascinating. Let's dissect it from the top and go through thought process. So the market's up here and it began a down move. We don't necessarily know that we would have caught that down move or not. Maybe there was a reason, maybe there wasn't. But we're focused on the consolidation pattern, so let's go there. So once the market found some support right here, it began to go sideways. So let's count the number of candles that it went sideways for, just for starters. We start counting from the low point of the consolidation pattern, where the red candle is by the black line that we just drew. If you count across to where the market began to break down, right here, what you find is there was 21 candles that the market went sideways for. Remember, 7's an important number, and multiples of 7 are important numbers. 7, 14, 21. 21's an important number. It's an important number throughout our lives. It's an important number in things we do. For example, certain games are played to 21. Blackjack is played to 21. Volleyball is played to 21. Multiples of 7 are important. You can see the market began to break down after that 21st candle, or on the 21st candle. What else do we have? The market found support at the 200 period moving average, which happens to be the black line running across the screen from lower left to upper right. That's the 200 period moving average. The market found support at that point. The market had traded away from the 200 period moving average for a period of time. Once it comes back into the 200 period moving average, the first hit is generally going to provide at least support. That's what we saw here. What else do we have? How about market symmetry? The distance from the breakdown point to where it originally found a low before the consolidation pattern, and then we have the secondary breakdown point from where the consolidation pattern was finished until the market found a low again. Those are relatively close to equidistant. That's market symmetry. You can begin to see how all the piece parts, all the components that we continue to discuss one by one, you see how they begin to come together and how we can utilize them to read the market. That's what our intention is. Our intention is to read the market because it's always telling us something. Our job is to try and understand what the market is telling us. In this case, The market was telling us that it made an initial move down, it consolidated, getting ready or building energy for another move down that in this case happened to be about equidistant to the first move down into a moving average that would generally provide support for the market. And oh, by the way, it went sideways or consolidated right here for 21 candles. So just in this little span of chart, we have market symmetry, we have the market moving sideways, consolidating for a specific period of time, in this case 21 candles, a multiple of 7. That's an important number. Another symmetrical move down into a moving average. When trading, two of the most important things that we can have is a good entry point and a good exit. In this case, our entry may have been on that 21st candle. We knew the market was consolidating, therefore it was getting ready to make another move. In this case, it's called a continuation move. We had an initial move down, consolidation sideways, and then another move down. That's called a continuation move. So our entry was based on the amount of time it went sideways. And the second thing that's important is an exit. How do we know when to get out? In this case, when the market came into the 200 period moving average, that's our out. It was a symmetrical move to the original move down, and it was into an important moving average. That would have told us to exit the market. We would have been short from the 21st candle, and we would have covered the short at the 200 period moving average. Symmetrical move, beautiful trade. Let's look at another example of a consolidation pattern. Here's another pattern that's very similar to the last one we looked at, where we have a top, we have a breakdown, we consolidate again, and then another continuation move, finding another low before the market reverses again. You'll find these patterns over and over and over again as long as you can train your eyes and your mind to be on the lookout for specific things on the chart. Not every move in the market is tradable. Not everything is a pattern. But when you can identify a pattern and identify the characteristics within that pattern, then you'll be able to take trades that have high probability of success. How long did this consolidation pattern last before the continuation move started? Well, if I start from the low over here of the consolidation pattern, this is where the market made a low and then the consolidation pattern began. If you count this candle as that first candle, you'll notice that it was 10 candles before the breakdown began. There's that number 10 again. 7 and 3 is 10. A lot of times, the market will either finish a move or begin a move on that 10th candle or the candle following 10. It's in that neighborhood. It's something that we need to have our eyes trained to find. If I see the market moving sideways for 9 or 10 candles, I want to be thinking in terms of, is this a tradable opportunity? The market went sideways, contained by the 200 and the 20 period moving average, and it broke down, and there was also market symmetry. The initial move down is about equidistant to the continuation move. After a while, spotting these patterns becomes second nature. They're high probability, the odds are in your favor, and you can trade them over and over and over again. Let's find one more. The last two we looked at were short trades. Let's find one that was in a market that was rising. Here's one on the bullish side. Now here we don't happen to have a perfect candle count. There's no 21 candles. However, the same concept applies. So let's dissect what we have. These breaks in the chart, here and up here, these are one day to the next. So the market gapped higher from one day to the next. It went higher, consolidated for almost the entire trading session. And then the following day, the market gapped higher again right out of this consolidation pattern that basically lasted all session long. So when you look at it with somewhat of a magnifying glass, what do you find? You find an up move, a pretty long consolidation pattern, which is the market's way of telling you that it's building energy to make the next move. In this case, once again, a continuation move higher. Now check it out. Here's the bottom, here's the top. is the consolidation pattern in between. So you have market symmetry once again. Traders, you will find consolidation patterns and market symmetry over and over and over again. What we're doing here is we're teaching you how to look at the market in a different way than you've probably looked at it before. When you see a consolidation pattern, there's a high likelihood that 7 or 8 out of 10 times it's going to work out with a continuation move following. Just like everything else, it's not 100%. Nothing in the market is 100%. Some patterns will fail, but any way you look at it, the probabilities are in our favor the majority of the time that you will get the continuation move.